Hey Central Virginia, the Federal Reserve is predicting that we're going to be in a recession by the end of this year. What does that mean for the housing market? We'll cover that today on your May 2023 Housing Market Update.
Minutes to the Federal Reserve's meeting in March show that the staff says the effects of the banking turmoil would likely lead to a mild recession later this year.
What's going on, party people? My name is Chris Elliott, team leader and real estate agent at the Elliott Real Estate Team. In this video today, we're going to cover what a recession could mean for the housing market. And be sure to stay till the end. We're going to give you 3 tips on how to navigate this market, whether you're buying or you're selling. Before we jump into the meat of the content though, if you like this video, if you'd like to see more of it, make sure you give me a like, give me a subscribe, give me a heart, give me a thumbs up wherever you're seeing this. Thank you in advance. Now let's get into it. All right, so first and foremost, what are we talking about? So the meeting minutes from the Federal Reserve's Open Market Committee from March were recently released, and I'll give you an excerpt from those meeting notes. They said that given their assessment of the potential economic effects of the recent banking sector developments, Silicon Valley Bank, the staff's projection at the time of the March meeting included a mild recession starting later this year, with a recovery over the subsequent 2 years. So the question for this video is, what does that mean for the housing market? So that means we're going to see a bunch of foreclosures, right? Well, not exactly. So while we saw a large number of foreclosures in the Great Recession of 2008, that certainly was not a typical, nor a normal, nor a mild recession by any means. If we look at the graph of the U.S. foreclosure filings dating back to 2005, you can see that we are sitting currently at a very, very low number of annual foreclosures. And if we look at U.S. household equity, you will notice that 67.6% of Americans either own their house outright, you can't foreclose on a house that doesn't have a mortgage, or they have more than 50% of equity in their home, meaning that they've got a good chunk of equity, they've got a lot of meat on the bone. Those homeowners are less likely to get foreclosed on because they are simply not going to allow that to happen. They're not going to forfeit all that equity in a foreclosure. And we really got to think about what was a huge contributor of the amount of defaults and foreclosures that we saw in the Great Recession of 2008. During that recession, or the lead up to that recession, we had a lot of home buyers, a lot of borrowers that were getting into homes with little to no money down. So it's much easier to walk away from a property that you have nothing invested in versus the situation that we're in today, where almost 2/3 of Americans, more than 2/3 of Americans, have either completely paid off their homes or they have a large chunk of equity in their homes. So we're not going to see a bunch of foreclosures, but we are going to see prices drop, correct? Once again, maybe not. So if we look at the last 6 recessions, you'll notice that only out of 2 of the last 6 recessions did we see prices decline. Now, of course, we saw a dramatic decline in real estate prices in the Great Recession of 2008. But if we look back to 1991, when was the last time that we had home price depreciation during a recession, you will see that was a very mild amount of depreciation. We saw roughly about 2% depreciation during that time, so nothing to sneeze at, but also not catastrophic by any means. And if we think about price as a function of supply and demand, we really got to look at where we currently are with supply and demand. If you look at the graphic over my shoulder, you will see the month supply of inventory in Metro Richmond dating back to 2007. Once again, and if you've seen any of my videos, I know I'm a broken record, but for anybody that's tuning in for the first time, month supply of inventory is a metric that we track in real estate that basically says that the rate at which homes are currently selling, how long would it take or how many months would it take to sell out the current amount of inventory if nothing new hit the market. 6 months supply of inventory, as you'll see, is considered a neutral market. Anything above that is considered a buyer's market. Anything below that is considered a seller's market. Right now in Metro Richmond, we're hovering at around 0.6, not 6, but 0.6 months supply of inventory. So we are very much in a seller's market, which means even if we saw a slowdown, the market would have to dramatically slow down for us to even get into a neutral market, no less a buyer's market in which we're going to see prices start to come down. So you might be asking yourself, what do we know about how a housing market responds in a recession? So one thing that we do know is we know that interest rates tend to drop at the tail end of a recession. Now, we will most likely not see interest rates drop in the next couple of months, as the Federal Reserve has stated that their public enemy number one for them is inflation and controlling inflation. So the way they control inflation is they raise interest rates, which in turn slows down the economy. but we know historically the Federal Reserve tends to lower interest rates or tends to lower the federal funds rate to kind of get things kickstarted again, to get us out of the recession that they are projecting that we are going to be in. And my personal prediction, I don't know that we're going to see interest rates in the threes again, or certainly not anytime soon. I think that was a once in a while type phenomenon, especially in the sub threes. So if you're sitting on the sidelines waiting for, to match your buddy's interest rate who got an interest rate at 2.5, 2.75, I just don't think that's happening anytime soon. All right, so what does this all mean for you? For my sellers, I'm telling my seller clients, make hay while the sun shines. So we are in an incredible market right now. I personally think that we are going to continue to be in a good market for a long while, but if you have any concerns about the future, know that right now the getting is good. We're seeing where properties are getting multiple offers, they're selling in a matter of days. So if you're somebody that is considering selling, that is a little bit nervous about what might lie ahead, know that you can certainly cash in right now and sell your home for a tremendous price. Secondly, premium prices still go to premium products. So what do I mean by this? So all of the things that we would do in a normal market to make sure that a home sells, staging, prepping the home, painting, replacing carpet, doing premium photography, doing videography, all of those things that we would normally do in a more relaxed environment, in a cooler market. We recommend still doing those things today. Yes, you can get your home sold without those things, but those things are ultimately going to get you the premium prices that are achievable in this market. And then last but not least, selling as is an option. So we have a number of clients right now that traditionally might have a hard time selling, but we are able to get those properties sold. We're able to sell them as is, just presenting the property for what it is in this current market, just because inventory is so limited. There's a good number of buyers that are just happy to see any inventory that hits the market in their price point. And as long as we're disclosing any known defects, as long as we're just presenting the property for what it is, we're still having tremendous success getting those properties sold. For my buyers, hate to break it to you, the recession is not here yet. So yes, there is potentially a recession looming in the future, but I can tell you right now, the market is absolutely still on fire. So if you're somebody that thinks they're going to be negotiating a tremendous deal right now, I hate to break it to you, we're not quite there yet. Secondly, interest rates are not a long-term problem. So if you are somebody that is concerned that the interest rates are too high right now, obviously you don't want to be overextending yourself. Don't buy a home that you can't afford at today's interest rates. But if you're thinking that, hey, this might not be a good time because interest rates are so high, just realize that if interest rates lower at some point in the future, you can certainly refinance to a lower interest rate. And if interest rates don't lower, they go up in the future, you're going to be glad that you bought now as opposed to waiting. And last but not least, I always like to ask clients to put things in perspective. What is your time horizon? So if the home that you're looking at buying, and maybe you're a little nervous about the prices are too high, or maybe you're a little nervous that interest rates are too high, obviously make sure it works for you in your financial situation. But if you're planning on being in a property for the next 10 to 15 years, historically most homes have appreciated in 10 to 15 years, and you're going to be doing okay, even if prices take a little bit of a dip, which honestly I don't think they will. But even if they do, if you plan to be in the property for the long term, over the long term, that property should appreciate. You should be just fine. So guys, there you have it. That was your May 2023 housing market update. If there were any questions that I didn't answer, if you disagree, if you have any thoughts, any comments, be sure to throw them in the comments below. Thank you guys for tuning in. Look forward to seeing you next month.